Do you ever look at a stock and wonder, should I buy it? Is this a good price or not? I'm going to show you how to value a stock using a discounted cash flow model. And the first thing we need is the market cap, which is $115.74 billion. And we're going to be looking at Texas Instruments. You know those great little calculators that you used in calculus class? So free cash flow is like the lifeblood of any company. Cash that's left over after operating a business and after capital expenditures. Next we need for the model is net income, which is a profit and loss. And that's also an important number for forecasting purposes. We also need the revenue, which is just the sales for each year. And you want to look at the numbers too. Make sure they look fairly consistent and there's no big negatives, because it's hard to value a company with negatives and with numbers that are inconsistent. So this looks pretty good. So I think we're going to be able to get a value for this company. We need the discount rate because every company has a different capital structure, just like you have your own credit score and your own risk monitor. So let's find out their capital structure. So they pay $170 million on their debt. Let's see how much debt they have, because there's equity and there's debt. That's the two ways you could finance your company. So current debt is $500 million, and that's debt due within 12 months. Long-term debt is $5.3 billion. That's debt due after 12 months. And they pay a little less than 3% interest on the debt. But interest payments are tax deductible, so let's get their effective tax rate. And sometimes it's hard to look at the income statement because they use accrual accounting. If they use cash accounting, it would be the cash that came in, it would be the cash that went out. It'd be very easy to look at the books. That's what a lot of small businesses use, is cash accounting. But big companies use accrual accounting. So something they bought today, they end up paying for it on the balance sheet over the next 10 years. So that's why we got to look for the right number to take. So we want income before tax. And I think 2018 looks about right. It looks like in 2019 they paid a pretty low tax rate. So you would need to look at prior years to figure out why they paid so low, but 2018 looks about right. The income before tax is $6.7 billion, and the income tax they paid is $1.1 billion. So 17% effective tax rate, that sounds about right. So when you discount the taxes off of the interest payment, they pay actually 2.44%. That's the cost to obtain debt financing. We also need to figure out the cost of equity, and we would get the beta for that. That's the volatility of the stock. That's how much it moves relative to the market. And they have a beta of 1.12, so it moves a little more than the market moves. And we also need a little more information from the balance sheet. So let's get their current assets. Current assets is cash, accounts receivable, and inventory. It's pretty much assets that can be liquidated into cash within 12 months. And the current assets is $8.7 billion. And the current liability are payables and debts, which are due within 12 months, and that's $2.1 billion. And the equity, that's the total assets minus total liabilities. Well, stockholders' equity, they call it. And the EBIT, earnings before interest and taxes, or gross income, operating income. And that's $6 billion. So they have 39% of debt in their capital structure. That's pretty good. So the rest is equity. So when you combine the cost of equity and cost of debt, you get a weighted average cost of capital of 7.58%. And that's the discount rate we're going to apply to the cash flows to see what the value of the company is. So we estimated the future free cash flows for 4 years based on the inputs from earlier. We also did a terminal value, which is all years past year 4. We used a Gordon growth model to figure that out. We discounted those numbers back to today's dollar amounts using the weighted average cost of capital. And the sum of the numbers is $76 billion. And when you divide that by 918 million shares, you get an intrinsic stock price of $83. So it's trading at a premium, a 52% premium, because it's actually trading at 126. So obviously people think the future of the company is worth a lot more than it is today. That's why they're bidding the price up beyond intrinsic value. Let's see what Simply Wall Street calculated for the stock price. They calculate $81, so that's pretty close to mine. It seems like their numbers are usually fairly close to mine. I think they use a similar valuation technique. A lot of people look to different things when figuring out the stock price. I use fundamentals, which is what we went over, the earnings, the revenue, net income, all the ratios. But some people use market sentiment, just how they feel about the company. If they feel like it's going to be profitable, but they have no real reason why, they may just start buying the stock. If you really think a company is valuable and it's going to go up, you got to just hold the stock for many years. That's the only way you'll ride out the ups and downs. A great way to analyze a company is look at the ratios. Let's look at those. So they have a PE ratio of 23.1. I like to see under 15. So that seems a little high, but always compare ratios to competitors, because you really don't know how well a company is doing till you compare it to similar companies. So that's price of stock over earnings per share, the PE ratio. The price to sales ratio is price of stock over sales per share. And that seems a little high as well, 8.0. And price to book is price of stock over book value per share. They have a really poor current ratio. They have way too much cash on their balance sheet, because a current ratio of 4 means they have 4 times as much current assets as current liabilities. They don't need that much cash and receivables sitting on their books. Because I invest in the company so they grow the company and provide me a 10% or maybe more return a year. I don't want them holding on to cash and earning 1% interest on that cash. I want them growing a company, open up factories, marketing, becoming bigger in different countries. That's what I want this company to do when I invest in them. But they have a great ROE, 56%. That's net income over equity. And that's how much value you're providing your equity holders. Because the net income is $5 billion for 2019. That's 1 year of net income. And their equity is $8.9 billion. So their entire balance sheet is worth $8.9 billion. They earn more than half of that in 1 year. So that's really impressive. 20% is what I like to see in a company. So they're doing a great job providing value to their investors, even though they're sitting on a lot of cash. So let's compare them to the competitors, because that's how we really can see if they're doing well. And we have Intel, NVIDIA, and those are the 2 biggest competitors. Intel is a monster of a company, the biggest by far. Texas Instruments is the smallest company out of the 3, but it's still a pretty big company. So PE, NVIDIA is just awful in PE, Intel is a great PE, and Texas Instruments is right in the middle. Interestingly, Intel has a current ratio below 1, so that just means they may have to take on a little more debt, but they only have 27% of debt. I don't mind this so much. Normally it would bother me if I saw a 0.5 current ratio, but that just implies they're doing a lot with their cash. They're not just letting it sit in a bank account. They're growing it. That's why you invest in a company. And ROE, I mean, Texas Instruments has just amazing ROE, and the others are okay. They're actually good ROEs, but next to Texas Instruments, it's nothing. And the debt, NVIDIA is good with debt. They're the lowest. All the companies are in good shape with debt. They're all below 50%, and they're all pretty big market caps. So it's interesting to see. So I think their ratios aren't so great just because their stock price is so inflated. If the stock price came down to the real world, like $60, $70, where it was a value, you would see these ratios improve dramatically. So let me know what you think of this company in the comments. Let me know what you think of the video. Thanks for watching.